Hello everyone, David here. Welcome back to part 3, where we dive deeper into a factor most traders often ignore, the time element. Today, I'll show you why the start of the European session is the golden hour for institutional moves, and how combining this with our bull and bear rules can drastically skyrocket your win rate. It's not just about finding a setup, it's about the discipline of sniping and waiting for every single rule to align before pulling the trigger. Let's get straight into the charts. This time element, people might often neglect or ignore, thinking that just entering the market, monitoring the market, whether morning, afternoon, or evening, there are always good opportunities to enter. However, the European session is the session where many large institutions and traders start operating. Clearly around 8 to 9 a.m. European time is the starting time of our office hours. So this time element is also a very important factor, which I already made a previous video about. You can watch that video again to understand more. We will continue to observe how the price movement develops. We can see the price continues to drop afterwards and runs to the take profit zone. Normally, when the time element appears and combines with other factors regarding the entry point, the overall market force, as well as having the logical structure of the bull and bear rules appear, then its ratio, its success probability is very high. I really like times when the entry point element and the time element appear together. The entry point appears exactly at the beginning of the European session like this. Of course, it doesn't appear frequently like that. An extra element appearing only increases the win rate. And that doesn't mean without that element, we won't enter an order. The important thing is whether it is a mandatory element in our rule set or not. For example, our mandatory rule set includes elements 1, 2, 3, giving a win rate of about 60%. Then, normally with enough elements 1, 2, 3, we will enter an order. But if it has an additional element 4, helping the win rate increase, for example to 70%, clearly we will be happier then. However, normally, our mistake is the opposite. We have a mandatory rule set to enter, which is 1, 2, 3. But because we are eager to enter an order, the rule set is only satisfied at rules 1 and 2. Rule 3 is not satisfied, yet we have already entered the order. So from there, we will increase the entry points with low win rates. The stop loss rate will be higher, and we have to spend more winning orders to compensate for those losses. It will slow down the process of becoming profitable. That is the advantage of sniping. At the very least, we must wait until the rule set is fully satisfied, or more. Not entering an order when it only seems almost enough, or simply somewhat resembles the entry point of the rule. That way, we will be completely deceived by the market. Next, also an order on the URJPY pair on the 5-minute frame. At the time after the previous order, which is the 8th of May, 2025, the order was entered at this time. We apply the same steps as the previous order again, which is looking at the overall picture. We can see that from this previous order, the price continued the downward direction afterwards. However, during this stage, the price started to create upward structures. And we can see here, when looking according to the bull and bear rules, the bears pushed the price down. Then the bulls stepped in, shown through the failure of the bears not being able to break down further past this bottom area. Every time trying to break down, the bulls resisted and created 3 bottoms, continuing to create an upward structure, reaching a previous base area of the bears. The bears participated in protecting this base to test how the bulls' force was. The two sides started struggling again in this sideways price zone. At this point, if the bears continued to prevail, to continue the previous downward momentum, then after this sideways phase the price should have broken down, continuing downwards. But here the price broke up with a long-bodied candle, quite strong and steep. Then the price pulled back to the zone it just broke, which is this zone. then continued to increase, breaking past the previous peak to create an upward structure going up. From analyzing that bull-bear structure, we can see this stage is starting to lean towards the upward force. The current is leaning towards the upward direction until it meets a strong base area of the bears here. Then here we can see the bears start attacking more strongly, pushing the peaks lower and lower. The bulls try to hold their ground at this area, but eventually fail. The price is pushed down. However, after this downward push, immediately there is an upward force from the bulls pushing strongly up. This upward wave is even larger than the previous downward wave. Of course, up to this stage, we still cannot say anything. The two sides are still struggling. That wraps up the core logic for part 3. Remember, the trading is not just about the setup, but about the patience to wait for the perfect confluence of time and structure. If you want to see how these rules play out in real time and catch the same setups I'm watching every day during the European and New York sessions, my trading room is always active and waiting for those who value discipline. Keep practicing these bull and bear rules, because in part 4, I will reveal how to manage your trades when the market gets volatile. See you in the next one.